We'll just give it a minute before we get started, but thank you guys for joining. All right, why don't we go ahead and get started? I will introduce our analysts in a second, but first we have to go through our housekeeping items. So anything you hear today is general advice. I don't know anything about you, and I can't offer personal advice. Neither can Nathan, neither can Johannes. Also, if you're in New Zealand and you would like a copy of our FAP, you can go to our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. So despite not being able to give advice, we would love questions. That's the whole point of today, that you get to interact directly with our analysts. So send through any questions. You can send them on the chat. You can send them in the Q&A, whatever you want. I'll get them to them. Also, anyone who's joining us on YouTube Live or Facebook Live or Instagram Live, you can also send through questions. They'll get relayed to me, and then I will ask the analysts. All right. So the first thing we're going to do, the first question will just be for them to introduce themselves to you. So let's, and so Shani just put in the chat their coverage. I will also put their coverage on their screen while they introduce themselves. And as you see, you can follow us on Instagram. I don't know if Johannes and Nathan, if you guys follow us on Instagram, but you should do that because you'll be able to watch yourself streaming live on there right now. All right, so I'll flip over to your coverage. Nice little candid shot of Johannes, much more professional of Nathan. But Nathan, why don't you go first since you're at the top of my screen? Do you want to introduce yourself and quickly summarize your coverage? It's obviously on the screen now. Nathan said he wasn't going to, he was going to flip off his camera if I asked him hard questions. So maybe that's what he's trying to do. How about Johannes first? Why don't we go to Johannes? So you're still on mute, Nathan. So are you, Johannes. So maybe if you guys want to unmute yourselves. Johannes, you want to introduce yourself? Are we having problems unmuting ourselves? Interesting. All right. Well, anyway, let's see. Who would like to help with this? If Shani or Will could help them unmute, that would be good. Or maybe this is a setting. Maybe I have to do this. So bear with us for a second. We do not do these group ones very often.
Okay, there we go, Mark.
All right, we did it. All right, so Nathan, you want to go? You want to go first?
Yeah, thanks for that. So I'm equity analyst responsible for covering the major banks, the regional banks, Bendigo, Bank of Queensland, and a smaller, probably less than one MyState. I also cover the insurers, and yeah, there's a few other smaller things like the general insurance brokers and Genworth, which is a mortgage insurer. So I've been covering these stocks with Morningstar for, I think it's been 2.5 odd years now. Prior to that, I worked for CBDA for a couple of years, helping advisors put together portfolios. And prior to that, I was actually equity analyst at Morningstar, covering a few different sectors. So in total, I've been an analyst with Morningstar, I think 12 to 13 years now.
Okay, great. And this is Nathan's first time on the webinar, but fortunately, as you know, Nathan, no individual investors hold any of the bank shares, so I'm sure you won't get any questions on those. we'll turn it over to Johannes, who is a veteran. So you came on here and talked about the Endeavor IPO, which is obviously in your coverage list. But yeah, you want to introduce yourself and talk about your coverage.
Absolutely. Thanks, Mark. Hi, everyone. Thanks for taking the time today. I cover the retail sector at Morningstar, and I've been doing it for about 5 years now. So I know the sector now quite well. Within that sector, obviously, we have consumer staple companies like the supermarkets, and then a raft of discretionary retailers. The largest one is Westfarmers. So if you think the big stocks that we cover here at Morningstar in retail would be Westfarmers, Woolworths, Coles, and also, as Mark just mentioned, Endeavor.
All right. So why don't we get into it? So we'll start with a couple questions from me, but then anyone else send through whatever you would like. But why don't we start, Johannes, since you're already speaking, why don't we start with you? So just in general, obviously you mentioned that you're recovering retail. A lot has gone on with COVID in the past couple of years, obviously with store closures, maybe an acceleration that we read a lot about, an acceleration to a shift to online shopping. I guess you want to talk a little bit about, knock on wood, the post-COVID environment, sort of what has changed in retail over the past couple of years.
Yes, as you said, Mark, a lot has changed, and one thing that is really on the front of any investor's mind in this space is, where are we going to end up? What's the new normal going to be? And that's really a change that is still happening as we speak. So, to your point, we had COVID, we had all the lockdowns, we had all the government subsidies, really firing up consumption, and really that consumer spending underpinning our GDP growth most recently. And now with all the government funding, the reopening of or subsidies, I should say, and with the economy now reopening, it'll be very interesting to see where we're headed. So, as I say, this is still happening as we speak, and there's obviously different opinions in the market. We are of the opinion that we will revert, if you think about where we would have been without COVID in terms of consumption, how many fridges people buy, how many televisions people buy, how many iPods people buy, and bread loaves. If you add all that up per capita, and your wealth growing obviously with that, you'd probably assume you'd end up somewhere on the same trajectory you were on 2 or 3 years ago, and that's the view we take. So, as I say, just imagine COVID didn't happen, consumption rising gradually in Australia. We believe we're going to hit that trend line again. Now, what the market's currently pricing in is, for a lot of stocks in our coverage, is that consumption is actually going to be a fair bit higher. And that additional dollar has to come from somewhere to begin with. And, the answer is probably going to be somewhere in between those 2 points. We, however, we're pretty confident in our view that over the next year or two, we will see that consumer spending come back to that trend line.
Yeah, so maybe a follow-up question to that. So what is something within your coverage universe where you think the market is mispricing a company based on views that this surge in spending will continue? Do you have an example that you can walk through?
Yeah, absolutely. There's quite a few, but I'll say Westfarmers, for instance. So Westfarmers is a large conglomerate. Most of our investors on the call might know it quite well, but Westfarmers owns Bunnings. That is their biggest business. The second largest businesses are the Kmart and Target chains. So together, Kmart, Target, and Bunnings are the vast majority of Westfarmers' earnings. And we've seen sales in hardware actually skyrocket during the lockdowns, and it's still elevated. And the department stores had been doing really well up until the recent lockdowns. So what's currently priced in is that we'll be jumping off this point of this elevated consumption into a forward forward world where everybody's just going to be consuming more hardware and more department store goods. And we would like to disagree with that view, and we see a normalization, if you like, on that consumption. So Westfarmers is perhaps one name to call out that's quite overvalued.
Okay, a little known fact, Johannes, I have only been to Bunnings once in my life, and I bought this little like flame torch thing so I could make cocktails, so I could make old fashions and caramelized sugar on an orange. So I'm not much of a man, but you guys know that as you know me. But everyone else goes to Bunnings.
So if you've only been there once, I take it you didn't burn down the apartment or the house.
No, I have not. I have not. Yeah. All right. So we'll get back, of course, to retail because I'm sure we're already seeing questions coming in. But Nathan, let's talk a little bit about banks. So a lot going on. We've seen a lot going on just with the share prices, but also we've got this environment where people are worried about inflation. Potentially, they're worried about higher interest rates happening sooner than central banks have indicated. What's going on with banks? And I guess what would be the response, you think, for both the business perspective and share price? Well, we'll say business perspective from potentially interest rates being moved forward.
Yeah, I think interest rates going higher before the RBA is currently talking is actually a good thing for the banks. That'll give them an opportunity to reprice their variable rate loans a lot sooner. But I mean, if you're buying one of these banks for a long-term view, whether that happens in 22 or 23, it's not really going to make much of a difference, right? Yeah, sure, it's great if it happens earlier, and that might be a bit of a catalyst for their share prices. But in our view, we're forecasting for a rate increase happen in 2023, so we'll see the bottom of their net interest margins in 23 before by 24 we start to see a bit of an improvement. And generally, most of the banks are priced around our fair value. Westpac's obviously the one that's been smashed lately, and I'm sure we'll talk a bit more about that. But generally, I think the market is pricing in that rate rise and the ability of the banks to reprice their loan books. Short term, though, and there is risks around their short-term earnings. We've seen a lot of demand for fixed. Owner-occupier has been very strong, and that's been lower margin for the banks. So we expect to see more pressure on their net interest margins or NIM in the next 12 to 24 months. Westpac highlighted an exit NIM, and when we say exit NIM, it's what the NIM was right at the end of that reporting period. So it kind of gives you an indication of where they are at that point going forward. And NIM was down quite a lot. And CBA's quarterly update, they said NIM's considerably lower. So we do think our current forecast capturing in some more downside it looks reasonable at this point. But like we saw, in COVID, their ability to reprice deposits kind of surprised, and just how much funding they got from at call deposits. So people just having their money in their savings account, which is free funding for the banks. So I think that's probably the biggest area where there's uncertainty at the moment for the banks. And loan impairments, that was the big thing during COVID, but they've all come out of it pretty good thanks to lots of free money thrown around everywhere by the government. So I think they're well provisioned. They've got plenty of capital. It's really the story now is about when will they be able to reprice loans and generate a better margin again.
Okay. Yeah. So maybe let's talk a little bit about this, because often on these webinars, we do talk about rising interest rate environments, not something we've really seen in a while, at least too much of one. Talk a little bit more about why banks generally do okay. So you talked about repricing variable loans. You also talked about them getting a lot of funding from savings accounts. So it's just sort of the mismatch in the timing of those repricings or the degree to those repricings that build in margin.
A bigger part of it is the bank's funding. So a lot of it comes from customer deposits. So there's term deposits in there, but there's also transaction account deposits. The money you just have sitting in a bank account, you might be getting a very small amount of interest for it, but often people get nothing for it. So the banks don't necessarily have to pay incrementally as much for those deposits as they will when they reprice the lending rate. So as the rate goes up, they charge more for the loan, but that funding isn't rising. The funding cost isn't rising at the same rate. So you get that sort of increase in the spread. The banks also invest their equity and deposits on swap rates, so 1 year or 3 year. So as the rates go up, they're getting a better return on their actual investments as well. So it's easier to make a bigger margin when the rate's higher.
Okay, great. And then what about inflation? So obviously we've talked a little bit about inflation maybe being the catalyst to move these rate rises forward. What impact, and we have a question from Rohan on this, what impact would inflation have on banks and insurance companies?
Yeah, I think generally it probably would be positive for credit demand. The one downside, and it's something the RBA is watching very closely though, if you've got inflation and then say you respond by increasing the cash rate and in effect people's borrowing costs, have their wages increased by a similar amount, or does that mean that they're going to struggle to service their loans? So I think that's one potential area which is a risk. I think the RBA's comments to date, and even them holding off when they will push rates up, suggest they will wait to see where inflation does sort of normalize, and also what sort of wage growth we do have in the next, because these really are unusual circumstances, right, where we've had no immigration, and many industries are struggling to find people. So it will be interesting to see where those things move. For the insurers, inflation generally would, again, there can be timing issues, but if they do incur inflation on their claims, so things are getting more expensive to repair, then generally what you're going to see is a negative impact on their returns, but then they will then pass that on to consumers. So in those environments, we'll see our premiums go up, because at the end of the day, these insurers don't really have a competitive advantage. They're just basically trying to price to make an okay return. And at the moment, that return is not very good. So as we see, these natural hazard events have been continuing. So it's going to be another tough result period for the general insurers. So if we do have high claim inflation, then yeah, I think that just leads to another round of pricing in the future.
Okay, great. All right, we'll switch back to Johannes. We'll just keep going back and forth. We have a lot more bank questions that we'll get to, but we don't want anyone dozing off here. So you guys dozing off, not anyone listening to you. So Johannes, we've got some questions around the supermarkets. Sort of number one, maybe if you could just kind of frame. So obviously we've got kind of three major supermarkets here: Aldi, Coles, Woolies. Maybe let's talk about Coles and Woolies for a second. So you give a narrow moat rating to Woolies, you give no moat rating to Coles. So maybe if you can talk about that within the context of supermarkets. And then we've got a couple specific questions. And once again, a moat rating is a sustainable competitive advantage. And I'm sure Johannes will obviously talk through the specifics of where that comes from.
Yeah, absolutely. And thinking about the supermarkets, and supermarket as a business, they're generally very low margin businesses, which means from all the sales they have, generally at the bottom line in terms of profit, it's a small part that drops out. So generally, globally, that sits anywhere between 2 and 4% of sales on the EBIT line. So before taxes and before paying interest, that's usually what the returns a supermarket generates. Now, what's really important for a supermarket is to have scale, because once they scale, they firstly can fractionalize what we call their costs. They can spread their costs over a much larger amount of sales, which makes each and every individual product cheaper in terms of cost. but it also means where supermarkets build big scale that they have a negotiation and they have negotiating power when they're setting prices with their suppliers. So think about Ingham's, for instance, supplying chickens to Woolworths and Coles. So the big supermarkets both have that negotiating power. So Coles and Woolworths, and all our analysis that we've done on this, and we spend a lot of time on this, doesn't suggest that either one has a leg up on that. So has more negotiating power with the suppliers. What Woolworths does have, though, compared to Coles, is greater scale. They have about 20% more sales, which means they can spread, as I said, their cost base, all the head office costs, the supply chain. If you think about logistics, if you think about warehousing and all that, they spread those costs over a much wider base, and that's evidenced in Woolworths just being more profitable. So that EBIT margin that I just mentioned at the beginning, and how much money really drops out on the bottom line for a supermarket, that is much higher for Woolworths than for Coles, and consistently so. So that's really where that competitive advantage that Woolies has over Coles really manifests itself, and you can see that in the numbers.
Okay. And if we sit there and we look at Aldi, which I actually read your research report lately, so on Woolies, and yeah, so Aldi, it seems like has been around since 2001 in Australia, but obviously has sort of continually picked up with more of a discount model. What impact has that had? And then Mim has a question talking about Kaufland, which I can't say that I know, but a foreign supermarket chain, will it return to Australia? Sort of how do you see that overall competitive environment? See any changes? See any big market share shifts or new entrants or anything there?
Yeah, that's a really good question. So if we go back about 5 years, the big concern was that Aldi at the time was taking a lot of market share from the incumbents, so from Woolworths, Coles, but also the IGA. And Aldi was rolling out a lot of stores very quickly, and we're growing that discount channel that Australia lacked. So Australia didn't really have that. But that is behind us now. So our view is Aldi's super growth, they're just going to grow in line with the industry going forward from here. So those big shifts in market share between Aldi, Woolworths, and Coles, they're a thing of the past. We still believe that IGA is a weak competitor as a group of independent supermarket operators, and the reason why we see them as weaker is not just because of the pricing. I spoke about scale and pricing powers and setting prices. That's one disadvantage that they've always had. But going forward, online is such a big part already in grocery sales and grocery retailing in Australia, and it's just going to grow. And IGA doesn't have a good answer for that yet. So as a lot of the growth we're seeing in supermarkets is now happening online, and not necessarily by opening up new stores, is that IGA will be at that disadvantage. So if there's any movements there in market share, it'll be Woolworths and Coles taken from IGA, while Aldi, in our view, will just continue growing with the market. So no longer a threat in terms of market share. But one interesting point that I like to raise with Aldi is Aldi's here for good. Aldi's here to stay. It has 10% share roughly in the Australian supermarkets segment. And what that means, having a big discounter, is that prices will have to be managed by the majors. So Aldi will keep them honest, so to speak. So with their really low pricing, they will firstly result in Coles and Woolworths to have at least one good in each category that will match Aldi. And Woolworths in particular has been doing a very good job in doing that. So keeping Aldi at bay, if you like, not losing share, matching them on the lowest price point. But it also means you can't see very high rises in prices. And Nathan and you obviously just spoke about inflation. And generally in supermarkets, any inflation over 2 to 3% would generally impact volumes. So 2 to 3% inflation rate in food is almost like a sweet spot for a supermarket. If you go beyond that, though, you'll be selling less volume, you'll be selling less items, and that again might hit the profitability. When we spoke about scale and all that, like when you sell less, that'll hit your profitability. So that's a one thing. And I think one of our guys here on the call basically said, hey, what about Kaufland? So Kaufland, I'm German. I know Kaufland quite well from back home. It's a hypermarket. It's basically a mix of a department store and a supermarket, half-half. Think about a Walmart, a bit like that, but really in the discounting segment. And it's actually a stablement of Lidl's. I'm not sure if a lot of you have heard of it, but it's now the equivalent. Kaufland was supposed to enter Australia. They had already secured 4 sites. They had bought land in Australia to build their stores, but then they pulled out a few years ago, pre-COVID. Now, given that they've pulled out, the risk is a lot lower now that they will come in country. So it is always a possibility to see entrants, especially from abroad, global players to enter. But our base case, our view is this will not happen. We do not expect any major player coming in.
Yeah, that's very indecisive for Germans.
It is.
Buying land, changing their minds. You must be quite embarrassed.
They've changed. Yeah.
Yeah. All right. So we'll get back to some stores. We've got a couple other questions out there. Let's go back and let's talk about Macquarie. So we always hear about the big 4 banks, Nathan. So I guess sort of your general thoughts about Macquarie, and then we've got a question from Phil saying, would you categorize it as a growth blend or income stock? So I don't know if you have any thoughts on that. Oh, we need to unmute you again. Cheers.
So I went on mute to have a glass of water.
It's okay. It's important to stay hydrated.
If you had to categorize Macquarie in one of those buckets, I would probably put it as a growth stock. And I think management has even shown that is their priority, to grow earnings. There's one equity raising this year, one a couple of years back, and they really show that their intent is have the capital on hand, find investments where they can generate a return for their shareholders, and over time, as their earnings base grows, that's going to be the greater driver of total shareholder returns. I mean, they still do pay a decent dividend because they've been growing earnings so strongly, so that's helped do that. But they have been lowering the dividend payout ratio. So I think the board and management, especially in this period of time, they're more focused on growth opportunities. So that's kind of how I think of it in terms of those buckets.
Okay. You mentioned Westpac sort of briefly and mentioned how the share price was going. Lisa, who is one of our favorite attendees, who owns 3 Alpaca, in case you're interested. She's asking about Westpac, and I just wanted you to comment on the current performance and share price. So maybe just a little more detail around what you mentioned earlier.
Yeah, I think so. Westpac had been lagging behind all the banks in terms of performance coming out of COVID, but obviously post their results, it's fallen quite hard. And I think there's probably 2 key things that stood out to us, and I think the market is probably even more pessimistic about. The first one was on net interest margins. So Westpac, like all the banks, have been flooded with loan applications, but at the same time as trying to handle that, Westpac's been sort of working more on the remediation, more on the risk management and risk culture following the AUSTRAC proceedings. So they've kind of been on a higher, kind of trying to be more conservative around everything they do, and that's slowed their loan approval times. They also had some offshore processing, so they had people that just couldn't get into the office to work offshore, so they've had to move that back, and that takes time to hire and build out that capability again. So they've been losing market share. So to try and get back to growing in line with the market, we knew that they would have to price pretty aggressively, especially with mortgage brokers. So that's obviously having an impact. And one thing we didn't appreciate, so Westpac is one of the bigger investor lenders. So obviously there's been this great shift where owner-occupiers are driving pretty much all of the credit growth. So as their loan book shifts more towards owner-occ, it's hurting their margins. And as we get more and more people taking up fixed, that's hurting their margins too. So there's all these things happening at once. So it's, I think, disappointing. The near term will be softer than what we had thought. But I think it's good to see that their loan growth momentum has picked up. They are growing in line with the market again. So to me, it shows that they can fix these loan processing issues. And I don't expect that we're going to see these same levels of loan application volumes going forward. And we certainly won't see growth from these levels. So I think that part of it, especially if the cash rate does get increased and then they start repricing. We already saw it. CBA and Westpac increased their fixed rate loans by, I think, 40, 50 basis points, depending on whether it was 2 year or 4 years. So that's the top line, where it was a bit disappointing. And the second one's on operating costs. So Westpac has added a lot of expenses to what they call fix. A lot of these issues around risk culture, customer remediation, IT messiness. And as they've gone down the path of getting rid of businesses, they've ended up with an underlying cost base which doesn't really, it's not as small as it should be given the new simplified bank that they're operating. So they've stuck to their cost target guidance for a couple of years, but we thought they'd be on a glide path down to that from now, whereas they came out and guided to costs being even higher next year. So that's where it gets a little bit, I think, a little bit worrying, where you're having to wait longer before you actually see them make concrete cost savings. And I guess the higher that cost base goes, the more it has to come down. So that's I think the two key things that have dragged on Westpac's share price. We're not forecasting they get anywhere near the cost base they're targeting by FY24. So obviously the market is a lot more pessimistic than we are. But around 1 billion, or a bit over 1 billion of the costs that they've associated with fix, we're pretty comfortable that they have a good line of sight of, these are employees we've brought on to work on specific projects, and when they end, they shouldn't be needed anymore. So we think a lot of those can come out. So that's why we're kind of giving them some benefit of the doubt that they'll take some costs out. But like we've seen many times in the banking sector, I think it's hard to take everything out just because of how competitive it is. And you've got these disruptors in the market as well that they might just be on the edges in terms of market share and how much volume they're doing, but they can sort of spur on innovation that has to happen across the industry.
So speaking of, and I don't know if you'll have anything meaningful to say about this, but speaking of disruption, we did have a question from Mim around CBDA and the fact that they are getting more involved in cryptocurrency. So does this have any meaningful impact on a bank the size of CBA, or this is just noise that's out there?
Well, I'll say something, but I don't know if it'll be meaningful. But I don't think it's going to have a material impact on revenues or anything like that. But I think what CBA is kind of just, there's been people call, I think Matt Common even saying it's riskier not to do it. So I think the risk is that, a competitor, like say an Afterpay, allows users to carry crypto and then allows them to do banking. And then all of a sudden you've got this ecosystem that the major banks don't have and an offering that the major banks don't have. So I guess the real question mark is how big does that become? Is this something that everyone is eventually going to want, or is it going to, just be, a minority? So I think that's kind of why they're doing it, sort of a just in case we're there. But yeah, I personally don't see it as being anything material, and I certainly don't see it as any reason why CBA is being sold off.
Yeah. All right, so you brought it up, so I'll ask. I know you obviously you don't directly cover Afterpay or Zip or any of the buy now pay later, but from a banking perspective, what sort of impact do you think this could potentially have on banks? Are more people going to shift over to those products rather than sort of a traditional bank credit product, despite many people refusing to believe that's the same thing as a credit card? That's my own commentary at the end.
Yeah, I mean, the personal lending books of the major banks, it makes up a very small share of their loan book. So if you look at CBA, it's 70-odd% home loans. The majority of the rest is commercial lending, and you've got a couple of percent in business lending. And yes, I think that shift away from a traditional credit card, or what we view as a credit card, it has been happening and probably will continue to happen. But I think the product innovation that the major banks, when I say product innovation, just basically mimicking what customers have wanted elsewhere, I think that will kind of slow how much leakage they have to some of these disruptors. I think the one area where some of these buy now, pay later providers have a leg up and the major banks will never be able to compete with is in terms of the onboarding process. So doing a full credit assessment and credit check, making sure that a borrower can service the credit. Someone like Afterpay doesn't have to do that. The CBA does. So there still will be pockets of the market that migrate to buy now, pay later, and which is potentially lost share. But I don't think it's going to be a huge thing. I think what the banks are doing as well in trying to fight back on that front is they all want the customer to open the mobile banking app and do everything in there. So they're trying to build as sticky as customer as they can. And so if Afterpay is sort of getting them to do more and more on their app, then that's a bit of a negative. So I think that's a bigger point to why they need to fight back at the moment.
Okay, great. All right, we'll give you a break for another drink of water. We'll head back to Johannes.
I won't mute this.
Okay, well, it's my problem. I need to figure out how to unmute you. All right, so we've got a question from Eric, Johannes, and he's saying, is the pricing of Westfarmers, Coles, and Woolworths driven substantially by them having recession-resistant revenues? So I think the pricing, whatever valuation metric we want to put on there, that all three are trading for. And do you think that is the case? Do you think that's a compelling reason to invest in these firms, or are people paying way too much, at least in the case of Coles and Woolies, for, as you said, low margin businesses without a lot of growth opportunities?
Yeah, I think you put it nicely, Mark. So
I was setting you up because I've read your research reports.
Supermarkets are exactly that. They're slow, they have slow top line growth. And if margins don't grow, that just translates into slow bottom line growth. And Woolworths and Coles are currently priced as growth companies, right? Relative to the overall market, if you look at like PE multiple. We don't use these to value them, but we obviously sanity check our DCF valuations by using PEs. And they look very expensive at the moment. So on Westfarmers itself, some people categorize Westfarmers as a consumer staple. So again, to the original point, like, is it a defensive name? Are the supermarkets ritzy because they're defensive? I would probably argue that Westfarmers not a discretionary, a consumer staple, but rather a discretionary retailer. Not just because of the department stores, but also because hardware has proven, and we've gone back to 1991 to Australia's last recession, did analysis on that back then, on how hardware sales, hardware retailing fared back then. And it really showed that food, liquor, yes, especially food is recession proof, but hardware isn't. So it might be priced at, and it might be conceived by or viewed by the market of being defensive, Westfarmers, but I wouldn't agree with that. And on the pricing and where we are in the economic cycle, to own a very defensive name for the sake of being defensive, well, I'm not sure if we're in that part of the economic cycle at the moment. So the big downturn is behind us, I would argue.
Okay, great. How about so we'll go over to online retail. So we've got a question from Fiona. So what do we say? So just sort of your comment in general on Kogan and what's happening with that. So we actually do have it. The share price has obviously bounced around a lot. Just looking at your fair value, so we've got it about a 25% discount to what it's trading for, or 25%. It's trading for a 25% discount.
It looks attractive. Yes.
Yeah. So what do you think?
Yeah, you're absolutely right. So the share price has bounced around a bit, and our fair value hasn't so much. And to us, Kogan is a very attractive investment opportunity right now. And the reason why we are bullish on Kogan is because they are in the right space at the right time. So I spoke about earlier that we'll probably see we'll probably see retail spending moderate and normalize. But what's happening at the same time is a shift, and this is a channel shift. So this is just where the same dollar used to all go into stores 10 years ago, and now a lot of that's going to online. So of the big pie that's consumer spending or retail spending, more and more of that is being funneled into online, which means the online channel, that retailing channel, is growing a lot faster than the physical stores. That's actually one of the things that came out of Kohl's and Woolworth's recent results, was exactly that's been happening even for the supermarkets. So something unimaginable only just 2 years ago, probably. So Kogan's in a fantastic spot. Kogan's a pure play in the online sphere. So it has all the exposure it needs to this really fast growing channel in retail. It's a well-run business. It doesn't have any debt, and yeah, we just believe there's a lot of opportunity for them to grow their marketplace going forward. So they're going to have a lot of top line growth, and hence a lot of bottom line growth, and it's undervalued.
Okay, and then maybe something we haven't really heard a lot about. So when Amazon entered the Aussie market, I know you spent a lot of time looking at it. You obviously don't cover Amazon, but covering the space, there would be an impact. You wrote a couple special reports. Now, that was a couple years ago. What, if any, impact have you seen on anyone from Amazon? Has it had a large scale impact in Australia on any of the retailers?
Funnily enough, it hasn't, or at least not measurably. We put that to a large degree out, a rising tide, a lot of boats float, or a different way of putting it, if you think about miners and the mining industry, when the gold price rallies, everybody's doing well, and it almost hides a lot of things that are happening maybe operationally for some of them that are not so going that well for the miners. And in retail is similar. So now we've seen all this spending, all this money flowing into retail. Every retail essentially has done quite well, at least of the big chains in Australia, and that's been under or masking that underlying trend that we do believe that Amazon is growing, and is growing very quickly. On our numbers, it is the largest. It's going in F22 in this current fiscal year. It's going to be the largest online retailer in Australia. This is Amazon, followed by Woolworths, Westfarmers, and Coles. But Amazon's going to be the number one. So
Okay.
it's
Flown
going
under
to
the
have an
radar.
increasing impact. It's flown under the radar, and it's gonna start hurting. And particularly it's gonna start hurting consumer electronics retailers like JB Hi-Fi and Harvey Norman.
Okay, right. All right, we'll go back to the world of banks and insurance companies. So we've got a question, Nathan, from Leonard. And, as you're very aware, there's been a lot of talk over the past couple of years about obviously bank dividends as they've been suspended and cut and come back. And then buybacks. We've had some buybacks announced. And so Leonard is asking, can you distinguish the impact of the buybacks on bank dividends in the future? Or is the impact lost in the smoke and mirrors? So, yeah, how are banks thinking about these two ways to return capital to shareholders? What impact do they potentially have on each other?
Yeah, so with the buyback, they're obviously reducing the number of shares on issue, so it's positive to your EPS and your DPS going forward. But the amount of shares they're buying back, it's not a huge impact. So I don't have the sort of numbers off the top of my head, like what sort of accretion you'd be getting, but it'd be small, a couple percent. I think the key part of the banks, making these buybacks is equitable returns of capital to shareholders when they don't have the franking credits. But I think the other part of why they've opted for this is, like Mark said before, we just went through a period of dividends going from, I think across the industry, the average payout ratio was 90%. Then it got cut to 50%. And then we've sort of rebounded now to the 70-75% range. And the banks could pay a higher payout ratio and use up some of that surplus capital they have. But then it gives investors maybe a false sense of security in thinking that, okay, now the payout ratios are back up again, and that's sort of what sort of dividend we can expect going forward. So I think that's another reason why the banks look to these buybacks more and more. The off-market buybacks in particular, so CBA and Westpac have launched, that's really an effective way of getting franking credits back to shareholders as well. So that's when you've got excess franking credits, you're able to return those to shareholders through that buyback. And the advantage for the bank and for all the other shareholders that aren't participating is they generally do them at a discount to the market price. So they're able to buy back more shares than they would have been able to do on market. So that's kind of the difference between the off-market, on-market buyback route.
Okay. I'll do another question for you, Nathan, but Johannes, there is something in German in the chat if you would like to read that out later. So just think about how you can answer that question. And obviously this is a family webinar, so please try to keep the language under control in case that's what's in there. But Nathan, the question is, the question from Rohan is, are the insurance companies, so IAG and Sun, trading low because of the bad weather forecasts over the next few months? Is there a particular reason? What's going on with the insurance companies?
Yeah, I think that is a big part of it. So it's not just what the weather forecast for the next couple of months, but it's what we've just been through as well. So these general insurers, they generally will provide or make an allowance for how large or how much money they think they need to set aside for large events. And then they'll buy reinsurance to try and mitigate how much they're actually, or how much of it actually hits their bottom line. So already they've had to increase how much or how large those natural peril events will be over the year and how much it'll cost them. So they're leaving themselves a lot smaller allowance for the remainder of the year. And in these wet periods, floods, hail, they can be pretty costly for insurers. I mean, it's hard to distinguish, and I haven't seen numbers actually break it down, and I guess it depends on the scale of the event. But if you think about a bushfire, more often than not, they're happening in rural areas where they're less densely populated, whereas a flood, it's generally in large parts of Sydney and Melbourne now, they're getting built more and more in flood-prone areas. So they're getting more and more costly for these insurers. So I think that is something that they're going to have to face in the near term, just how much reinsurance they buy if it doesn't get too expensive. But these things do go in cycles, and I think we are going through a period where these events are costing them more, and like we talked about it earlier, the cost of repairing some of these events might be rising as well. So a bit of a double whammy. So yeah, I definitely do think that's weighing on their prices at the moment. Okay,
great. So Johannes, I'm getting requests that I try to read out this German phrase. I don't know if that would be entertaining for you. But we've got your name, Johannes. Was denkst du über die Zukunft von, I think, Flight Center? So what does that mean? And how is my pronunciation? If you had to give it a star rating, what would you give my pronunciation?
I'd give it a 4.5.
Okay, that's out of 5, everyone. Remember, that's not out of 10. Okay, yes. So what does this mean? Is this just a question about Flight Center?
It is. So what do we see the future of Flight Center? And
I mean, you have to say it in German.
Caveat. No. The caveat here is obviously that I don't cover Flight Center, but as a group we do. So at Morningstar we do. Brian Hand, our leisure analyst, covers Flight Center. But in a nutshell, Flight Center, for Flight Center, we do expect them to return to their pre-pandemic levels in terms of earnings by 2025, and that's really as all this, as I say, the pent-up demand in travel as that returns. So it'll take some time, but we see them returning to those pre-pandemic levels. And I think another important thing on our view, or what our view hinges on, is that they have enough cash on balance sheet, so they have enough money to see them through to fiscal 2023 at current activity levels in terms of travel. So right now we're not too concerned about the balance sheet or liquidity for the firm, and our $18, I believe it's an $18 fair value, which is basically very close to where it's trading, is based on that outlook that by 2025 we'll be back to normal in terms of traveling.
I think part of the thesis as well is more of a mix shift to corporate travel within Flight Center's earnings.
Yes.
So that's where Brian sees a nice growth runway as well.
Wow, that was very good of both of you covering for your colleagues. See, normally I filter out any questions that aren't, on shares that you cover, but when there are different languages that I can't understand, yeah, that's good. All right, so I think we are out of questions, which is good because we're almost out of time. But I did want to thank both of you guys for joining. So we'll continue to do these webinars with our analysts, try to get some new people in there since Johannes has been on every other one at this point. But we'll be back in the new year, and we'll pick 2 more team members, and we'll bring them on here to answer any questions. So anyway, thank you guys very much. As always, if you have any questions, you can email me at mark.lamonica1@morningstar.com. I would request that those messages are in English, but other than that, I'm willing to try to answer anything. So anyway, Nathan, Johannes, thank you guys very much, and thank you guys for joining.
Thanks, Mark. Thanks everyone for the questions.